I want to test buying the low and shorting the high, and I'm using a strategy called test falling knife. And here is what the falling knife strategy looks like. It's a general idea. Buy the next bar at the low of the day of the set of the day since midnight. The low D function goes from midnight to midnight. Sell short next bar at high D, high of the day from midnight to midnight. That high level on a limit. Says stop loss 1,000. Set profit target 1,200. Holding positions. What does this work like? This is a mean reversion type approach. And when you look at a day like today, it looks like an incredible trading setup to use. If you look at some of these short trades, long trades, short trades, long trades, really nice trading performance. What does the data tell us though? If we go back, say 5 years, what does this look like going back 5 years? It's not a very good approach, but when you zoom in, you see this massive spike right here. Boom. If you look at the periodical returns, February is up 7,440. December it had a 9,000. Every now and then you see a really good month. Let's look at the dailies on this. The last 3 days were massive days. You get these streaks where it's massive. A really good approach to trade, but how do you discern that without optimizing your strategy? I don't have an answer for that yet, and what happens at those lows would be distinguishable. You have to make sure you don't optimize it though. It's very hard to look at this and say, yeah, you know, I want a strategy that catches that spike up, that spike up, that spike up. Most of the time it's straight down. To try to fine tune this so that it catches these small spike ups is tricky, but I'm open to that. What I want to do is look at the opposite of this strategy. So what happens if I say short the low or buy the high? Does that work any better? Let's comment out that because these do the opposite. So we don't want to do the same thing at the same price. We're buying the high of the day, shorting the low of the day, and that's difficult to do. Doesn't seem like it would work anymore. Let's see what the results are. So if we look at the results of this, you see the equity curve is much, much better. It's kind of flattened out a little bit here recently. It's not running up as much since May of 2021. Sometimes you can use a longer term strategy to help you characterize a market. Since May of 2021, it's not breaking out as much to the upside or to the downside, but it is still trending higher. And this is just a model. The average trade profit is too small to trade. We won't trade this strategy. It has a $24,000 drawdown. The average trade profit, this is without slippage and commission. So this would be negative. It just does tell you though that the characteristic of the market is better to buy highs and short lows. Finding a good way to do that, you don't take every high, you don't take every trade where you buy the high and you short the low, but you have to find better ways to do that. Today, like today, it just seems like a good day to buy the low. You see these constant rescue missions by the dip buyers, pulsing the market higher here, pulsing the market higher here, and so it's not what it seems. And so if it's possible to find a way to buy those pulses off the lows, but simply buying the low and shorting the high is not the best way to do that. And in general, you have to be more specific in your approach if you're going to do that. And in general, taking a trend trade works better overall in the markets. Hey, David Bean here. Welcome to Capstone Trading Systems YouTube page. Be sure to subscribe to join our community of algorithmic traders. We are real money traders. We share our winning streaks, we share our losing streaks, as well as market updates, strategies, and coding tips.